You will agree with me that there are lots of books on stock market investing out there, and also there are lots of complications. But in today's video, I'll try and make it, a lot easier to understand and follow, but not compromising on the returns. And this will only take you about 30 minutes to do every month. So I'm just going to go straight into the video, and we are going to be taking it step by step. So step number one is you have to pay yourself first. So this means that you need to have income flowing into your account every month, so that you also have money flowing into your investment account every month. And this is really important. So let's say you have $5,000 as income every month into your checking account. So what I do is I take 10% of my income and I put it into a high yield interest savings account. So in this case now, 10% of $5,000 is $500. You put it into a high yield interest savings account, and that is your emergency fund. Okay, now step number two is you need to automate your savings and your investment account. And this step is really important when it comes to consistency in investing, which is so important when it comes to building wealth with investing. And for you to be consistent, you don't want to trust yourself to manually do that every month, because you will most likely forget. And this doesn't mean that you're not serious. It's just that sometimes you're occupied with life. So you need to automate it so that you don't do it yourself every time. And it's also part of investing system that you need to put in place. Okay, now next step, which is step 3, is to use stock market investing principles. This is where it gets advanced, but not something you cannot do. And there are 4 investing principles I follow. First one is asset allocation. The second one is index funds, ETFs. So I just want to list them before I start going into them one after the other. The third one is rebalancing, and the fourth one is dollar cost averaging. This dollar cost averaging is so amazing. Since I learned it, it has become a game changer. And it's the reason why Warren Buffett gets excited when there is market crash. Alright, so let's go into the first principle, which is asset allocation. This is basically how I divide my money when it comes to investments. An example of asset allocation is having 30% of your investment in stocks, 40% in real estate, and 20% in bonds. So bonds are the very secure investments. It's almost like lending somebody money and they will pay you back. The rate of returns when it comes to bonds are not that great, but it has a downside risk. And also, real estate investment doesn't have to always be physical real estate. There is real estate stock you can invest in. It is called REIT, REIT, Real Estate Investment Trust. So with the asset allocation example I gave earlier, changing the percentage is everything. Just a little percentage change can really have a huge impact on your investment returns and also downside risk. But always remember that returns can vary. Okay, let's say you are close to retirement and you don't want to take so much risk in investing, or maybe you don't just want to take so much risk in investing, you want to follow the conservative approach. Here is what you can do. You can put 70% of your money in bonds, 10% in US markets, and 20% in international markets. And if you do this, your average return for 20 years will be 8.62%. But for your worst year, you should expect 8.99%. So the 8.62% takes care of the worst year. Now, a more balanced approach should be to put 40% of your investment in bonds, 20% in US stock markets, and 40% in global stock markets, including Canada. If you do this, you should expect 9.5% return for that 20 years and about 3.03% for your worst year. Again, the 9.5% return takes care of the 23% of the worst year. Now, I know you might be thinking, why should I take that much risk for just 9.5% return and a huge 23% hit? I know you'll be like, it doesn't just make sense. But you see that 9.5% return, it compounds every year for that number of years, which is 20 years we are using for example. And this has turned into thousands and hundreds of dollars. So it's definitely worth it. So here are some advantages of asset allocation. Number one is it decreases your risk. And this is because you don't have your money, all in one place. You can call it diversification. Imagine you have all your money in real estate and for some reasons the real estate goes down. What do you think will happen? So you definitely need to diversify. The second advantage is that you will experience increase in upside return because you're taking advantage of all the markets. The bonds, the real estate, Canadian market, US market, all of them. The third advantage is that it is absolutely free. So you don't need to pay anybody to do it for you. You can do it yourself. So let me give you an example of a low effort asset allocation. So you have 25% of your investment in Canadian stocks, 25% in US stocks, and 25% in international stocks, and also 25% in bonds. This is simple, and for me, this is how it should be. Simple, because if your strategy is complicated, you will be worse off. So this means that your money in your investment account should look like this. See, I cannot overemphasize the importance of asset allocation because investing is not all about buying any and everything. It is going to show in your returns. That's why asset allocation is very important. Okay, now principle number 2 is to use index fund, ETFs, exchange traded funds. This is really great and I have explained it in my previous videos. So in step number 1, we have allocated our assets. But now, what do you buy? Should you buy BlackBerry? Just joking. But you have to buy the index fund. And to explain this further, there is active and passive investing management. Active investing is mutual funds, and what this basically means is you, me, and other people, we give money to someone, the mutual fund manager, and his job is to take our money and make more money. That is to say, to outperform the market. This mutual funds manager, they go to school, they read papers, they study the economy for one specific goal, which is to outperform the market. Now, passive investing is different. It is like saying, okay, we are not trying to outperform the market. We just put our money in the market and we're not going to get greedy. Okay, I believe that the reason why active investing, that is mutual funds, is still existing is because some people just want to have that feeling that someone is behind their money and he or she is actively, trying to outperform the market and make more money for them. But in the actual sense, according to statistics, only about 8% of all mutual funds managers actually beat the market over a recent 15 years period. So this means that 92% of actively managed funds fail to beat the market over a period of time. So this basically means that if you have a mutual fund, you have 8% of that fund outperforming the market and 92% chance of the fund failing to outperform the market. That's what it is. So I am choosing passive investing, ETFs, and I'll be using the S&P 500 to explain this. The S&P 500 index fund comprises of the 500 most successful companies in the US. And because of the large size of the companies, it makes up about 80% of the overall market value. So you have eBay, you have Amazon, you have Facebook, you have Ford Motors, Bank of America, and so many other amazing companies in S&P 500 index fund. And do you know that back in the days before index fund was introduced in 1975, you have to individually buy these stocks of all these companies, and this will cost a lot. So the index fund mirrors and matches the performance of a market, in this case index, and is not trying to outperform the market. Now, over the 10 years, the S&P 500 got an average of 9.2% return, while the mutual fund got 2.54%. So these are some of the reasons why I prefer ETF. But this is not a financial advice, just sharing my experience. And please, if you think I'm making sense at all, can you please hit the subscribe button if you haven't, and like this video so it will get to people that needs to see it. A very big thank you. So now I just want to give you some quotes from some smart investors. So David Swanson says, on an after fee, after tax basis, over a reasonable long period of time, there's almost no chance that you end up beating the index fund. And look at this quote from Warren Buffett. It's so simple. Indexing is the way to go. Invest in great businesses without paying all the fees of a mutual fund manager, and hang on those companies and you will win over the long term. So here are the advantages of owning an index ETF. First is low cost, as low as $100 or below $100, you can buy it. Number two is they are diversified, and this is one of the things that makes it amazing. Assuming you have the S&P 500, for example, and let's say for some reasons one of the companies goes bankrupt, you still have 499 other companies keeping you up, which is good. So the next advantage is minimal fees. You should not be paying more than 0.6% fees for any index ETF. If you do so, it is no longer ETF, but the average fee on a mutual fund is 2.35%. And the next advantage is it is liquid. So this means that you can take it out anytime easily because it is not a contract. The next one is it is very easy to use. Now, because this is a masterclass and it is going to be long, so I can't finish it in one video because I don't want this video to be too long, because I need to explain it properly and I don't need to bore you so much so you can understand. So I'll be back with part 2 of this video and probably the last part. Meanwhile, I have a beginner investing video which I believe you should watch first to fully understand this one if you are a beginner or you are just new in investing. So thank you all so much for watching, and I'll see you in my next one.